Okay, good morning, guys. I hope you're well and had a good weekend. Interesting week ahead, packed full of data, and we've got an FOMC meeting positioned midweek that will dominate, but definitely an important week for data as well. We've got GDP readings for the UK on Tuesday. We've got, more importantly, GDP readings for quarter two from the US on Thursday. And so, important macro news flow that's going to come in. Last week it was a little quiet on the data front, the macro data front, that is, and it was the turn for US earnings season to just come a bit more into focus and, take the lead when it comes to these asset prices moving, and you certainly saw that on equities. If I just enlarge my S&P chart, then here we are, already back into the middle of this range. It's been a pretty phenomenal couple of weeks, really. First on the upside, post Greece, so on the other side of the Greek crisis, once at least an initial deal was arranged, and Greece for now have avoided a default, plus then actually a better than expected start to the earnings season, propelled the index up to the top side of this range, but it all came not crashing back down, but certainly a unidirectional week, 4 down days in a row here, with Friday being the biggest as the index lost 1%. And perhaps the kind of headline event of the week was probably the Apple earnings that disappointed, but you had disappointing earnings from others as well. It wasn't just Apple. Some of the other tech space disappointed, Microsoft, for example. You did have mixed news because obviously Amazon delivered some pretty phenomenal numbers. So it was a mixed bag, but by and large, the negative side, so companies like Caterpillar, companies like McDonald's, Biogen on Friday dropped over 20% on the back of their earnings. So the earnings season just took a turn for the worse, with some of the big hitters delivering disappointing numbers, and we've drifted back into the middle of this range. You can see on the right-hand chart here, just behind the S&P, the DAX is almost back to the important price point, the 10th of July low. So, again, a pretty interesting couple of weeks, first on the upside, now on the downside. And so far this morning, at least, markets have woken up with a little bit of a hangover. I mean, the DAX is down over 1% already today. So definitely a negative vibe as we begin an important week for macro data. We will still get the micro stuff coming in. It is still earnings season. We've had almost 200 of the S&P 500 companies report earnings now. By and large, it's kind of normal, or at least kind of in line with recent quarters, where we've seen about 77% of companies beat their earnings per share forecast, but then only about 53% beating on the revenue side, which is kind of opposite to what we've seen in Europe. Europe is the other way around, in that the outperformance comes on the revenue side. So you've had about 69% of European companies beat on their revenue forecast, but then I think it's about 63% have beaten on their earnings per share. So you're seeing, and this is a currency thing, right? Euro dollar's phenomenally low, although we have had a bit of upside this morning. The euro is strong, but I'll come to that in a second. But generally speaking, if you're comparing the exchange rate, euro dollar, to this point last year, well, then we're radically lower. And of course, this plays into the hands of the European exporters, so revenue in Europe on the up, whereas it penalizes American exporters. So revenues in the US not climbing, and of course in many cases declining. IBM with the standout one, IBM have had 32 months in a row of declining revenues. So we move into this week where attention will shift back to the macro focus. Now, if we just see, commodities have been a big part of the week, last week actually, but generally commodities have been a big player over the last month or so. Look at this decline we've had in crude oil. Just looking at Friday's low, we broke $50, of course, middle of last week, an important technical break. This fed through to a couple of more down days in a row. Going into the end of the week, the low on Friday puts the crude oil price at 23.7% below the point traded back at the start of May. So this is a bear market, of course, and there's not much in the way. We were looking at this technically last week. There isn't much in the way. We've got a kind of technical support from the 1st of April. So April's low is around about $47. We're trading at $48 as I speak. So weakness coming in here as a result of perhaps a little bit of dollar strength, continued concerns on the demand side from China, and then just a continuation of the oversupply situation. We've seen Saudi oil output creeping higher, despite the fact that OPEC's official stance is they're keeping production unchanged. It's kind of not true. They are increasing production. And then when you get the Iranian diplomatic progress made with the US and the potential for more Iranian crude to become available, well then the supply side dynamics have again helped on the downside here. But this isn't just an oil story, it's a commodity story across the board. The Bloomberg Commodity Index is down at an 8-year low. Copper and iron ore and gold, I mean, it's right across the spectrum, not only industrial metals, not only energy here that we're looking at, not only but also precious metals. So I think this plays a very interesting part in what's going to happen on Wednesday when we get the Fed statement, because the Fed, we're right now, well, this is the final meeting before potentially we could get a rate hike. A lot of people talking about September for the Fed to start their rate hiking cycle. So it'll be interesting this week to see if Yellen gives any guidance as to whether September is going to be the date. I think she won't. I think she'll remain fairly, on the fence. I don't think they're going to give clear guidance that there's going to be a rate hike or not in September. I think they'll carry on with their theme, which is they're data dependent. But the thing about the commodity space decline over the last month, what does this mean for inflation pressures? Well, it's very negative, of course. So I think September's off the table. Not that the Fed will say that, but I think it's off the table because, or one of the main reasons, is because of this latest cycle lower in commodities, which will carry on the depressed inflationary conditions. So I think the Fed are going to wait, but of course an important update on Wednesday. So we'll see if this commodity space remains under pressure or not. Definitely an important market, oil of course, but also other commodities. Check out the Bund. So for European core yields last week, yields moving lower, price moving higher. Pretty consistent. It wasn't not much momentum to this move last week, although it picked up a little bit as we got towards the end of the week, but a very steady, slow march higher. And you can see the clear target here for the Bund. It's at 154.24. That's the July high. Just above that is the 50% fib level of this big sell-off we had through May and the start of June. So core yields have been drifting lower. As we still have a Greek risk. It's not that it's gone away. We still have this negotiation process ahead of us over the next couple of months where they're going to try and nail down this deal, this 3-year bailout extension. But look, just look at Eurodollar. That's probably been the most interesting market of the morning here. And perhaps we're back to this inverse correlation. Maybe this is what's tipped the balance on European equities, because you've got the euro pumping higher, and this isn't just against the dollar. We've had a sharp move higher in the euro against the pound as well. So a nice kind of breakout, and we're just taking out the 110 handle properly, breaking above last week's high, and marching up towards the 111 handle. So a bit of euro strength, which is feeding through negatively in the European equity space. So the big events of the week are definitely the US Q2 GDP figure on Thursday, and then the Fed on Wednesday. But let's just look at today. Some interesting data, and we've got some coming very shortly. But look, this is the calendar for the whole session. I'll talk about German IFO in a second, because we've only got 7 minutes till this gets announced. This is the most important data of the morning. This afternoon, though, we get durable goods orders from the US. This will be important guidance for that GDP figure that we're expecting on Thursday. We're expecting a pretty healthy plus 2.5% number for June, looking to repair the damage done in May, where we got a pretty large negative print of minus 1.8%. So these are the two big data points of the day: German IFO, the business climate number, and US durable goods. On the earnings front, it's quieter today. We'll get some earnings really picking up as we go through the week. But let's just look at the German IFO number. What we're expecting is for the number to decline again marginally. So what we've seen, this is the, well, as you can see, if you look at the text here at the bottom, it's a business climate index. It measures entrepreneurs' sentiment about current business situation and, more importantly, their expectations for the next 6 months. So 7,000 firms across sectors get surveyed, and really this is a great measure of, what are the conditions like on the ground in the economy, in Europe's biggest economy. And we had a pretty consistent uptrend off the October low from 2014, nicely stepping higher until we've kind of got into Q2 of this year, and things have just tailed off a little bit. If you just had a look at this chart on a slightly longer time frame, let me just load it up, looking at back to 2012 here, then we're kind of, the peak we had this year is nowhere near the peak we had at the start of 2014, and already we've lost momentum and we're drifting lower. We've had the Greek risk, of course, that has been damaging. I guess from an exchange rate point of view, the euro dollar did bounce off those March lows, and perhaps that euro appreciation didn't help either. But generally speaking, the German business confidence number, which is the most important, so that is how confident are these business leaders about economic conditions out over the next 6 months. These are the guys that have got their finger on the pulse of the economy. They're right at the coalface, so this is why it's such important news. So this data is going to be coming in 4.5 minutes' time, and definitely the most important data of the morning. So I'd say, look, we've begun the week on the back foot on an equity, from an equity point of view. Plenty of stories in the FT this morning, actually still focusing on the energy sector. News that apparently $200 billion worth of projects have been cancelled in the energy sector as a result of the collapse in the oil price. Chevron looking to perhaps cut their workforce by thousands. They've already cut their workforce by 1,500 people. More cuts expected. So this latest wave lower for the energy space or the oil price is again turning attention back to the fact that CapEx in the energy sector has been killed by this more than 50% decline in price. So you've got the energy sector leading the way. The S&P 500 moved lower on Friday. The index was down 1%, but the energy sector was down 2.5%. So, and just generally the commodity sector is getting hurt. So we're on the back foot as we begin this week. Technically, for the S&P, it's difficult here because we're right in the middle of this 3-4 month range, and so if we cycle back to the bottom of this range, it means we've got plenty of room to move lower. We've got another 40 points until we get down to the very important support areas just above 2030. So the European equity space under pressure, perhaps because a little bit of euro appreciation. The Bund, so the debt space is actually flat. Oil is down, but quite stable. So we're just going to now take the lead from the German IFO data. It's due in 3 minutes' time, and then we will go from there. But the big news of the week doesn't come until Wednesday when the Fed make their statement. It then comes on Thursday with an update, first preliminary reading for US GDP in Q2. We're also going to get revisions to Q1. There's rumours that they're going to revise Q1 GDP from the negative minus 0.2% up into positive plus 0.3%. We're also going to get annual revisions going back 3 years, apparently. So plenty of GDP focus as we get into Thursday. We also have GDP focus here in the UK on Tuesday, with the first kind of lead economy delivering their Q2 growth numbers. So let's see how we get on. This week has begun. We're a little bit hungover here. There's a little bit of weakness in the equity space. Let's see if this German IFO number can reverse that or not. Enjoy the session.